I will welcome the next fantastic panel here. Carmen, there were you. I was like, where are you? Carmen, come up here, and then.
Thank you.
Good to see you.
Yes, likewise.
And welcome your fantastic panel. There's one thing I should ask you, and that is to project your voices, because we are having people that are also seeing us from far away. Hi. And they can't hear us as well, especially when people coming in and out the doors. So shout, okay? Good.
Yeah, please, panelists, please take a seat. Thank you, everyone, and thank you for being with us and choosing us. I know there are lots of competing sessions going on, and I see lots of people in different places this week. And may I say how lucky we are to have air conditioning, because not many people do have this luxury. I've just come from a session that I've opened at the London School of Economics, where I work, and on the just transition. And this is a reminder that despite the heat wave that we're experiencing, we're lucky to be able to have fans, to have air conditioning. And actually at the LSEG today, they were even giving away ice creams. I don't know if we love the same luxury here. Anyway, my name is Carmen Nuzzo. I'm professor in practice and the executive director of the TPI Global Climate Transition Center at the London School of Economics as part of the Global School of Sustainability of the LSE. And I'll be the chair and the moderator of today's panel that focuses on how to align capital to transition plans. Very few words about what I do at the LSE. The TPI Center was created in 2022 on the back of an initiative that dates back to 2017, because back then the focus was very much on, soon after the signing of the Paris Agreement, the focus was very much on companies' net zero targets, where these companies, the first ones that came to the fore, investors didn't know what to make of them, they didn't know if they were ambitious enough, and they didn't know if they were aligned to the Paris goals. So they approached the LSE to ask for help, and we partner with LSEG, which is the data partner of the initiative. So we're a very unique partnership, academia, investors, and a data provider. And we came up with a two-pillar approach to start assessing companies, both on the decarbonization pathways and also on the climate governance that they were putting in place. Since then, we've also started covering banks and sovereigns. So we assessed these three different entities. And really, over the last 10 years, the focus has very much shifted beyond, I wouldn't say away, but beyond net zero targets, and much more on transition plans and performance, which is the focus of today's panel. So without further ado, I'm delighted to introduce you to my panelists, very distinguished, who will help us navigate through what it takes to align capital with transition plans, bringing different perspectives. So I'll introduce them, starting from you, Julien, who are sitting next to me. Julien is the head of climate solutions and data analytics at LSEG here at the London Stock Exchange Group. At the other end of the panel, we have Thiago Toscano, who's the CEO of Mineração. He provides the perspective of the company, in addition to the one of the data solutions provider that Julien will talk about. We're lucky to have Dr. James Wilde, who is the Chief Sustainability Officer of Standard Life, formerly known as Phoenix Group, one of the largest pension funds here in the insurance fund here in the UK, and last but not least, John Willis, who's Senior Director, Corporate Performance and Accountability at the World Business Council for Sustainable Development, or WBCSD, as we refer to them often too. So I've said in my introductory remarks that the focus has very much shifted in the last few years beyond net zero target alignment and on the transition plans. And perhaps I'm going to start with you, Thiago, because you are in the eye of the storm. You have to provide the transition plans that investors, policymakers are scrutinizing more than ever. We haven't got that many transition plans. And from the investor perspective that I work very closely with, it's very good to establish what good looks like. So perhaps can you take us through your journey and what your company is doing about this?
Yeah, sure. Good morning, everybody. From our perspective, we are a mining company, and on a mining, even critical minerals or iron ore like us, the mining is there on the ground. You cannot choose other place to go, as an industry can do so. And because of that, it's not difficult to fundraise money. So when I stepped in Itaminas 2024, I started having conversation with investors and banks, and they said, why are you going to accomplish the IFC performance standard? You don't need to do that. It takes too long. And in fact, we fundraised $150 million in 10 days with a company, and we just signed a contract in 2025, and last week, $300 million with a Chinese, $300 million with a Chinese trading company. So it's not difficult to fundraise because it's a global market, everybody looking for the mining. But the thing is that what started bothering me is that people doesn't want to work on a mining company because it devastates from their standpoint. So we had to create, and we ourselves, we have to connect with the transition plans, with the decarbonization agenda. And when we did so, we kind of expanded the universe of investors and players. And so we designed all Itaminas strategy to the Middle East because the steel industry was moving there, because of the costs of energy here in Europe and also the cost of labor at the sea bonds here. And when we did that, we established a subsidiary company there in Abu Dhabi, and we've been talking to PIF, to Mubadala, to Oman Investment Authority, so it's not a problem. But when it comes to the ground, it's more complicated. When I come back one of the days, we are in Sazedo, a city with 30,000 people living there, and one time, very simple people living there, and one time the lady comes to me and said, hey, my kid, all this decarbonization agenda you've been talking about, we'll be able to have bath on the waterfalls again here in the municipality because we could do that 40, 50 years ago, and now it's polluted. And I noticed that the community and the territory was not connected to this agenda. So we had to go beyond. And that's not for accomplished standards. It's just by doing the right thing. In the end, you will benefit of that because the community comes with you. There are no turmoils. It's much easier to live with. So we were motivated to do that. And 2 years later, even from this negotiation, we noticed that not only we accomplished the IFC standards without being obligated to do so, but I had some conversations with my friend from IFC, and I said it's missing some performance standards on the 8 IFC standards. It should be 11 at least, bringing prosperity, bringing quality of life, and also bringing happiness to the community. So that's what we started doing more than the standards, and that kind of refreshed the pressure over us, and we are doing a great job so far.
And it's great that you're engaging with the community because that gives you a social license, so to speak, to continue your activity. But if I may follow, at the TPI Center, everything that we assess is based on publicly available information. So how much are you willing to disclose beyond the IFC standard compliance? Because one of the struggles that we have is, for example, companies now have net zero targets. They have the governance in place. They may have a board member who has oversight of the transition. They start disclosing Scope 1, Scope 2 emissions. Scope 3 are a bit more challenging. But when it comes to the actual CapEx, the capital expenditure, there is reluctance to do so. And I understand that there may be competitive reasons that can prevent companies from doing that. But we're really lacking the quantitative metrics that show how a company is transforming its business model. And the mineral sectors, of all the ones that we assess, we are very focused on hard-to-abate sectors, is probably one of the most interesting and challenging ones to follow because you're very much in demand, but at the same time you have the decarbonization journey to accomplish as well as big social issues to address, as you mentioned.
That's the part that I like most, in fact, because I don't have a mining background at last until I joined Itaminas in 2024. I barely know the difference between ore and iron ore. So the shareholders told me, and I told them, I'm not a geologist, why don't you hire a geologist? And say, no, because you need to do the rest, governance, ISG, institutional. This I can do. And in fact, it's very hard not only to do that, but also talking to advisory company, because all the companies I start talking about that, they said, okay, I'm going to make an assessment at Itaminas. We're going to bring some benchmarks, and then we create your roadmap so you can be very good on ESG. And I said, that's not what I want. I want you to go to your benchmarks and tell them that they're not benchmarks anymore, because Itaminas is now the benchmark. But I don't know what the benchmark is. And we start talking, and the companies they do not understand that. And until we got at ICLEI, it's an NGO connected to the UN, and we bring them to help us develop what we call them the voluntary local review, which is not any performance standard known, because the voluntary local review was created on the 2030 agenda. All the countries were aligned to create a voluntary national review. But on 2018, the United States decided not to launch its review. And the city of New York decided to do so. And that what became known as the voluntary local review. And other cities started doing that, voluntary local review. So it's a municipality standpoint or a state subnational standpoint. And when it comes to Itaminas, I said, that's what I need. Because it's not about me, my performance standards, but it's about the community, it's about the territory. So we provoked we motivated the municipality of Sarzedo to create its voluntary local review. So it was the first voluntary local review made in the world by a mining company, which was created in a partnership between the private sector and the public sector. The first one. And because of that, we were invited to present that on UN, on the United Nations Economic Commission for Europe, because it was completely a different standpoint. It's not what I'm impacting on. I look at the territory where I am. I have the 17 SDGs. I have the KPIs developed with 700 people from the community that decide which would be the KPIs, and then a pipeline of 120 projects. Some of them will be developed by us, some by NGOs, some by other private companies, some by the municipality. But everybody looked to the same to the same way, the same direction. And yesterday, as a coincidence or not, the municipality became a bill, which every mayor will have to launch its voluntary local review, because of political cycles that we have in Brazil. So we're very proud of that, because that started with an idea, and now it's true. We launched the first one, going to be every year, and with the support of the community. So it belongs to us. I'm part of the community, and that's the way we see it.
So if I hear you correctly, there is a power in collaboration and peer pressure, so to speak. So doing this voluntarily, but you're doing it together with the others, so maybe it doesn't pose a question.
Exactly.
I will come back to the question on the CapEx, though, because that's something that is still very much failing on these transition plans across the boards that the world that we assess. Thank you for that, Thiago. James, turning to you, you're a large asset owner. You're in the driving seat. We talk to asset managers and asset owners. The asset managers are telling us, well, we do what the asset owners tell us to do. It depends on the mandate that they give us. So how important are transition plans in your investment processes, and how closely do you scrutinize them?
Thanks, Carmen. Yeah, they're critically important, transition plans. They're key in going from commitment to clear plans to action. And if I just start with Standard Life, we're the UK, one of the UK's largest long-term savings and retirement businesses. We've got about 12 million customers, 300 billion of assets. It's just been announced, actually, that we're going to acquire Aegon UK, so that will move us up to 16 million customers and close to £500 billion of assets. And at the moment, 1 in 5 people have their pension with us, so it's really important how we invest.
Including John's pension.
Including John's.
This is why I'm listening.
You've got my pension.
Exactly. So we actually set our own net zero transition plan. We were one of the first financial institutions to do that. Just as the guidance were being released, we used the TPT guidance and the GFANZ guidance to do so. Really important. We took it to our board, and it creates a structured roadmap for how we're going to decarbonise our portfolios, engage our 12 million customers, engage to change the system through thought leadership and policy advocacy, but then also lead by example through our supply chain and our own operations. But how we use transition plans in our investment processes really comes through in 3 areas. The first is we've rolled out climate-aligned benchmarks, and we're looking to roll that out across our full 160 billion liquid equity and credit portfolio. The second is in our stewardship approach. There's always an 80-20 rule. About 25% of the assets are responsible for over 90% of the emissions. There's 25 companies that are responsible for 40% of the emissions. So we have a targeted stewardship program for those 25 companies, and we use transition plans as part of that. The third is in our core expectations of companies. So we encourage companies to put a net zero transition plan in place. Maybe to unpack the first 2 that I talked about. The first is the climate-aligned benchmark. We actually developed that in collaboration with FTSE Russell, and it's a really important measure, as I described. We've created a roadmap to decarbonise our portfolio. It's one of the key measures to help us to get to a 50% reduction by 2030 in the carbon intensity of our assets that we directly control. To date, we've rolled it out across 70 billion of our 160 billion assets. We've got a roadmap to roll it out across the rest. And really importantly, it's our key pension default is using this climate-aligned benchmark, our sustainable multi-asset. That covers 2 million customers, about 42 billion of assets, and the underlying funds have the SDR, Sustainable Improvers label as a consequence. It's all about maximising outcomes for customers. So we basically put in a tilt to improve the carbon performance of the portfolio. We're managing risk by underweighting companies that we see significant transition risk with, and we overweight companies where we see opportunity. But we keep an overall level of exposure to each sector, so we're underweighting, overweighting according to how well companies are performing. And to bring that to life, so how does it work and how do we use transition plans? We target a 7% per annum improvement in the carbon intensity. We start by applying our exclusion policy and remove any companies that are excluded. Then we tilt, and this is where TPI come in. We're all collected here. So TPI, we use the carbon performance score to look at their forward targets. We use the management quality score to look at their transition plan. And then we also look at the overall carbon performance. We do a lot of analysis to make sure it does create good outcomes for our customers. And the good news is, to date, it's been either equal or outperforming the parent benchmarks that it's linked to. The other area, just briefly, is stewardship. So it's really a critically important part of the objectives we set of those 25 companies I talked about before. We use tailored objectives aligned to the TCFD framework. So under the strategy, we look very, very closely at the transition plans of the companies that we're engaging with. And we've just reached the end of our first 3-year engagement cycle with those 25 companies. And I'm pleased to say that in our recent stewardship report, we laid out that 63% of all the objectives we've set of companies have been met. So really great to see tangible action happening.
Thank you, James, and thanks for the vote of confidence in the TPI in the TPI data, and thanks for the shout out. We're lucky to have you as supporter of the TPI because not all investors are, so to speak, so illuminated and committed to the cause. What struck me about what you said is that you have quantitative targets for the companies that you invest in, because I took note of a 7% reduction that you have. And you also spoke of a 3-year cycle, so you don't expect an improvement immediately. But my follow-up question is, what happens, now that you are at the end of the cycle, what happens with the companies that haven't complied? The reason why I'm asking this is because we have, in our assessments, we have now companies that have their net zero targets aligned with Paris goals, maybe long term, but near term they don't have a credible transition plan. But we also have companies that have got net zero targets that are not aligned, but they have transition plans that show some progress over the next 2 to 3 years. So the question for the investor is really, where would I put the money in terms of credibility? So what happens with the question is like, what happens if they don't comply? Exactly.
Yeah, it's a really important question, one we've spent quite a lot of time thinking about, actually. And you do see quite varied performance across those 25 companies. There's some that have met pretty much all of the objectives we've set, others where they've underperformed. There aren't any, actually, that we're going to divest from. Our core philosophy is to stay engaged because we can have much more influence if we can have a constructive debate with those companies and keep that pressure on. But there are some that are on our watch list. There's a couple where they've only met about 20 to 25% of the objectives. That's close to the threshold we set. So those ones are ones we're going to kind of keep on an active footing, and then maybe think about escalation routes as well. So become a little bit more pushy in our ownership, active ownership. We tend to try and do things very quietly and constructively behind closed doors.
That's very helpful, thank you. And really, I really believe in the power of engagement as opposed to divestment. That should be really only used as a last resort, or if it's done en masse, it works. Not to say that it shouldn't be used, but there is evidence that shows that if it's a tiny asset owner that only divests, may grab the headlines for one day, but not really move the needle in terms of cost of capital. So thank you for sharing that. John, you work with many companies, including mining companies, some of the largest companies in the world. They claim to be committed to sustainability, but you also see a lot of tension, particularly at the executive board level, between the short-term performance, if these are listed companies that they have to honor or demonstrate, and these long-term commitments. Can you share with us how are these companies grappling with this tension?
Thank you. I think you've set me up a bit here because I've got a corporate on one side, I've got an asset owner, and then a data expert, and then a professor in academia. But anyway, I'm gonna give this a go. Look, clearly, corporate. So WBCSD, sorry, it's an incredibly long title. We represent about 240 global companies. You can see those on our website. And everything we do is Chatham House rules for very obvious reasons indeed. Look, corporates clearly have short-term pressures. And let me just, I'm not being an apologist. These are just the pressures that they're under. So the obvious one is quarterly reporting. Interesting whether I was speaking to the SEC, actually, whether that changes. A lot of the corporates at the moment are saying, even if it does change and they have to go to half yearly, they're probably going to stick with quarterly, but will listen to what investors want. So quarterly reporting is a pressure. It may slightly change. Let's sort of watch out for that. Clearly, companies have to respond to events as they're happening. So whether it's heat waves, whether it's Hormuz or whatever it might be. So that obviously is always going to be short-term because you have to do that to be operational. The reality is a lot of executive incentives are still quite short-term. And that links also to tenure, you're being an exception, of course, tenure, but the average CEO is now about 5 years. And you think, well, actually 5 years isn't that short term, but a lot need to really get embedded in the business in year one, and year 5, they're thinking about succession, quite frankly. So you've got 2, 3, and 4. You know, so 5 sounds long, but actually isn't. So those are all in place. But one myth, and I keep hearing it time and time again, is that actually the financial markets are short term. So of course, all the corporates respond to that. I've obviously indicated some short term thing, but the financial markets aren't all short term. And there's clear evidence. I would say the clear evidence at the moment about that is if all financial markets are so short term, why are they investing in AI? And in a number of cases, there's no profits at all. Why have companies invested in Amazon that's never paid a dividend and keeps reinvesting in the business? So I just want to say there are, of course, short-term investors, but they all get put into one big bucket as if they're all sort of high-frequency traders, which is simply not true. And then I would say, if you look at the corporates, there's actually evidence around that where they can be long-term because they've got to meet shareholder expectations, they are. So a lot of R&D programs are long-term and investors support that. Some come to good and some simply don't work. I would say decarbonisation, if you start investing in carbon capture systems, etc., that is long-term. A number of investors support that. I mean, obviously I could go on. Infrastructure projects, they're really... So there is evidence of long-term, but corporates and the people running them will respond to the incentives in place.
Thank you for bringing that distinction out, because you're right. We often talk about investors as one category, one bucket. I mentioned earlier asset owners and asset managers, but even within these two broad categories, there are different risk tolerance levels, and depending on the product or the issue that they want to invest in, they may have different approaches. So that's very true, and the time horizon shifts with that. Julien, as a data solutions provider, they will come to you because they want to identify risks, they want to measure risks, and they want answers from you. How do you help your clients, both on the investor side and on the corporate side?
Yeah, well, thanks a lot. So, well, within LSEG, we have different kind of activities. You've seen capital market, there is FTSE Russell, and we also have a data analytics business, so we provide data and solutions to help. So I'm kind of sitting in between Thiago and James, trying to extract the information that Thiago would like to bring to the market and giving that back to James, which is really difficult.
And we need to assess this in our analyst struggle.
and it's really difficult because, well, you have many different kind of objectives. Well, are you interested in green economy or in decarbonization? Are you looking at past trends, or are you looking at forward-looking indicators? And so which kind of question are you answering? And I'm sure that you all know the say, if all you have is a hammer, every problem looks like a nail. We would like to be able to provide a toolbox just to make sure that, well, we help you to answer every question. So how does it work? Well, from a company perspective, I think that one of the really important stuff is to make them know what good looks like. And so being able to provide information about peers is something which is extremely important. Because when you start this journey, it's really great to focus on what good looks like and company well ahead of the race. But, well, if not everybody is doing it, it means that at some point it's pointless. So being able to give back this information is something which is critical. We also provide solutions. We have a corporate reporting tool that we provide to corporates to try to make reporting simple and to enrich that with our data. We work with regulators and standard setter. This is also really important. We cover a universe of 15,000 companies. If you define your framework based on the companies which are ahead of the curve, honestly, it would be really difficult to onboard all the other ones. Tomorrow, you ask me to run 20 kilometers, no way I'm going to do it. 5, maybe. So I think that it's really important. I'll try, at least.
I won't even do that.
So I think that it's really important also to balance this, to be able to capture, well, the fact that not all the companies are at the same stage of the transition. Nevertheless, it's important to capture which ones are actually doing it and want to do it. And so it brings me to the investor side. Again, a lot of different questions. Well, maybe it's just comply to regulation, or it's to engage deeply with investors. And so you don't have the same kind of need. We provide data to comply with regulation, of course. We also have a framework which we call Climate Map, from management, ambition, performance, to try to organize the complexity. And behind this framework, we have models. So one of them is TPI-MQ, which is the key indicator of our management pillar, but we also have...
Can you say what?
Sorry, TPI Management Quality Score.
Yeah.
So yeah, the name says it. So it's really important in the management pillar. So what are the company doing in terms of management and governance to tackle transition? Ambition, that's the forward-looking element. So we have a lot of target data, but we also have the implied temperature rise model. And performance, it's mainly around greenhouse gas emissions. But maybe the way you want to look at it is slightly different from the way we framed it. So it means that we need to be able to provide you with the underlying data points, because maybe you are not really interested in, well, past decarbonization of greenhouse gas emissions absolute data. You prefer to look at greenhouse gas emissions intensity among peers. And that's also a really sensible way to look at that. And on top of that, again, for investors or people who really want to engage deeply, we provide the underlying documents. So the source document from which we extracted the value. So I think that being able to provide all these kind of different layers is something which is really important. So I would like to quote a French poet and essayist from the early 20th century. You might have heard I'm French. Everything simple is false. Everything that is not is unusual. And so I think that this point is really important. Our challenge is not to choose between simplicity and accuracy, but to manage to simplify the complexity in a way to remain decision useful, which means that you need to be really transparent on how you do it. At the end of the day, I think that our job is a little bit like map making. The map is not the territory, but a good map helps you to navigate because it's clear about scale, legends, purpose, and limits. And this is really what we try to provide to companies and investors.
Wow, thank you for adding also the literature touch. That was powerful. But what you said about the map up here makes me think it is quite right that we can provide guidance and show the way forward. But at the end of the day, the goal is the same, but companies may choose different pathways to reach the same end goal, depending on the sectors they're in, depending on the technology that is available, depending on the jurisdiction that they're in. So all of that needs to be taken into account. And so that's, I think, where the challenge is when it comes to transition plans, that the comparability is very difficult. But what you said about chunking the work, even if it seems daunting, trying to simplify it as much as possible, because really, on the investor side, what they need is simple metrics, but sometimes companies may have good reasons for not disclosing these metrics, but they have to explain why that's the case. But at the same time, the power of benchmarking can be quite phenomenal, because if investors can go to a company and say, if this competitor of yours has disclosed this information, why can you not do the same? So even that can help. I have a question actually for all of you, and I'm conscious of time. I would like to leave a little bit of time for the audience to raise their questions if they have any. But ending on a positive note, we know that the task is difficult, and I can testify that there is a lot more that goes on behind the scenes that what the reporting makes us believe, or the headlines of the newspapers may make us believe. Because when we put together investors and companies, yesterday we had a workshop with the World Business Council here, they tell us a lot more than what they actually report, because sometimes there's also fear of litigation. But anyway, in your sphere of influence, if there is something that you could change, not tomorrow, but in the near term, what would you suggest could be done, starting perhaps from the company at the very end?
Yeah, I think we have to reduce the asymmetry of information.
Sorry.
Sorry. Yeah. I think we have to reduce the asymmetry of information, because I totally agree with you, John. We respond to incentives. We are now changing the whole fleet into electric trucks because it works. Right? But when you look in a broader view, and I think I would propose, Carmen, us to not to use social license anymore, which I think it was a great advance, because social license means that I give you something and you allow me to operate in your community. And we have to co-create, we have to work together. We have to talk about the progress of the territory where I'm in. Because if you look at that side, then we turn the social environmental pressures from liability into asset. So what happens for me now being here at the World Climate Invest Summit is very important, because everybody looks at mining and says it devastates, and you don't connect the importance of the mining for a green future. And so first we have to reduce the asymmetry of information between the society and what we really need in terms of mining. And then from us, I mean the executives, the C-levels, that being here makes my reputation better. It's good for me. I can access capital in a lower cost for long terms, facilities. And I can benefit myself for that in terms of environmental, in terms of social, with a framework to work in. And so first, by changing from liability into asset, we will deal with in a different way. But it's very important also to have frameworks to work on, because the majority, I'm an economist, so for me it's easier than the geologists there. So if they all agree with me, they get to their chair next day and say, okay, what do I do? And that's not about standards. It's about doing different in this way. So I think that's what's missing. So then we can put transition plans in action.
Yeah, so we need you to walk the talk.
Okay.
John, very quickly.
Yeah, very quickly. One thing I'll say is I do think I've listened to a lot of meetings and everyone sort of, I think, suggests that actually transition plans are not that difficult. After all, it's all about your company continuing, but they're really difficult. And they have to be dynamic. They have to, because things keep changing the whole time, they've got to be interconnected because you've also got to look at what competitors are doing and things. The context is complex. I accept the context is always complex, by the way, and integrate. You've got to integrate it into your financials, quite rightly so, to be meaningful. But people also talk about integration. Oh, you're doing climate. Can you do nature? Can you do social?
So
they're
what would
all
you
important. So what we're really focused on is actually the delivery. I think we can spend a lot of time finessing the actual target, and I'm not saying that isn't important, but we're really focused on hardwiring that delivery.
Okay. Thank you, John. James.
I'll perhaps focus a bit on incentivisation. It's been mentioned a couple of times. We're about to enter our next kind of 3-year engagement cycle, and learning the lessons from the first phase and integrating nature. One of the things we did just recently actually is look at the correlation between the benchmarking I talked about, the low carbon benchmark, and the performance in the first phase of what the companies did. And we found some really good examples of correlation. So to bring it to life, National Grid and Nippon Steel did really well in terms of the objectives we set, and were overweight in our benchmark. I think it'd be really powerful to communicate to companies, you're doing a good job, and we're overweighting, that's affecting your share price. Because I know when our large investors write to us and ask these questions, we respond. Bringing that financial incentive to life, I think, could be quite powerful.
Yeah. Thank you, James. This is music to our ears because we really want to bring forward the success story as opposed to only bashing companies who are not doing the right thing. We need to put the pressure on them because that's also an incentive, so to speak, if it's reflected in the cost of capital. But there are companies that are actually making progress, and those should be celebrated. They might not be there yet, but others can take example for sure. Julien.
Yes.
We have, a
really
few more
quickly.
minutes, very quickly.
I think that what's ahead is really and it has been mentioned already, it's really to move from commitment assessment to accountability. And so being able to track delivery against commitment is something which is going to become more and more important. And I think that the related question is also to make sure that, the credibility of the commitments are also embedded in the forward-looking analytics, and indicators like the TPI Management Quality Score are definitely a good way to do that. Again, a net zero target by itself doesn't mean anything unless the company is really wanting to do it and is really investing and managing it. So I think that we really need to be able to distinguish between the one talking and the one doing.
I've had a yellow warning and now a red warning, so I'm really terrified. Do we have 1 minute to take one question? 1 minute, if you need to be quick. Okay, all right. Really quick.
Sony Kapoor, I chair the World Benchmarking Lens. Quick question. So taken together, your decisions on climate sustainability criteria to deviate from the weights of the index, how much does it add up to? Are we talking about a sum total of 2-3%? Deviation 10%, how macro significant is your overweighing and underweighing from the index because of sustainability criteria?
We do put limits as to how far we'll move away from, we do put limits as to how far we'll move away from the overall index. And really importantly, we keep the same level of exposure to each sector. So we're tilting within each sector rather than trying to have paper decarbonisation, moving from carbon intensive.
How much the deviation? In the single digits, low single?
I would say it's in the single digits.
Yeah, maybe we can take this over the break. Sorry. Thank you so much. The panel was really short, but thank you for an amazing contribution to you all. Just to say something. on the Transition Pathway Initiative website. They're free to use and that's for commercial purposes, so do take a look. Thank you. Thank you so much.
Well done, well done. And thank you, Carmen, also for making sure that everyone speaks up.
Thank you.
Yes.